Hello, I'm Gary Shotton, and I'm here as a part of Inspiring Better Business. Many people have talked with us by phone on developing nations, and a common question and problem that comes up is not money or capital to get started. And the next thing that follows from that is, can I get a loan? And I'm going to talk today about an unsecured loan so that we can separate the ideas of just any old loan into two major categories. One, a secured loan, and the other's an unsecured loan. And I hope to give some light and shed some understanding on the difference of the two and maybe help people. Well, first of all, as implied here, we just say the word loan and we lump everything into one big group, and it's not that. There are two distinct groups. And to start out, let's talk about a secured loan. In the United States and in the developing nations and in the larger cities in the developing nations, there's banks, and these banks work on what's primarily considered secured loans. What do I mean? Well, when you ask for monies and they fill out an application, they're going to ask a significant amount of questions. They probably will not give the loan unless it's for a particular purchase of an asset like land or building or a piece of equipment. I have a lot of loans on a piece of for equipment, or you could say a car loan. So they're going to require that this asset be secured against the loan. This means that if the loan fails or you don't pay the payment, that piece of property, the car, the equipment, the building, the land, now becomes the owner, reverts back to the person that owned or offered the loan. So it's secured with some kind of an asset. An unsecured loan is when you just trust the person and you believe that person's going to pay you back, but there's no guarantee in the sense of a sellable asset. So when many times in a foreign country, there's someone says, well, will you give me a loan? They're going to not be able to put up much of a security or secured, so it's an unsecured loan. In the United States, credit cards are by and large unsecured loans. Now, here's the difference in the interest rates. On a credit card, it could be 18 or 20% interest because it's risky. On a secured loan in the United States, it might be between 5 and 7%. So don't think that you can compare the two because they're distinctly different. Now, when you're loaning money in a developing nation, or you're borrowing money in a developing nation, I strongly encourage you to lean towards the secured loan arrangement and not be insecured in your loan. Now, there's times that I have been asked to help out. I have followed a biblical example that I don't co-sign for other people's loans on a typical basis. But I also would even personally consider loaning a small amount of money to someone I had a lot of confidence in, but I would never loan that money without the realization that I may have to, what I call, kiss that money goodbye and never see it again. And I need to be mature enough to say also that would not alter my personal relationship with that person, because I don't want to have a best friend. They borrow some money from me, they can't pay me back. Now our relationship is marred. And even if I am mature enough and say, hey, I'm just going to forget that, it's all yours, I gift it to you, I'll guarantee you that person's probably going to feel a little bad about that. There's where going to family members, mothers, grandparents, brothers, sisters, that's risky, because if you get an unsecured loan at any interest rate and you cannot pay it back, then the individual's relationship that you have is very difficult. I'll just put it blunt. Christmas time is not going to be fun. You're not going to want to be in the same room with a person that you couldn't pay them back on their loan. And you're now going to be, your relationship is going to be marred. So this is very important that you understand the difference between a secured and unsecured loan. Now, we're working with groups in developing nations, and we're strongly encouraging that they join into what's called a community savings bank or community savings group. And in doing that, now you're creating some much needed structure. First of all, everyone's loaning money or putting money into savings. That's a good habit. Start saving a little bit, even if it's $1 a week. It will build up. And then the reference, as I understand, instead of a national record of your pay history, like your credit history, the group knows that if they bring somebody into the group, someone, as I understand, is willing to vouch for them, to say, this is a person we can trust. And then over time, they can borrow sums of money from the group, and it's interesting that they call that hot money. That's their term internally, because that's within the group. And the people borrowing that money sits amongst a committee, a group, maybe 10, 15, 20 people, that their group that's in their community. Most people don't want to use that as a chance to be disrespected for 20 people, 10 people. They want to keep that avenue of financing opening because it's both available in some way for disasters or situations that unexpected that normally insurance would help in, and you could borrow some money to get out of a jam. And it's also available to borrow small amounts of money to advance your business. So those people that are in that community that are long-term in that community don't want to, in essence, lose that option for the rest of their period of time, whatever it may be, until somebody trusts them again. So it's amazing how this community savings group has lowered and has created a good scenarios for people to do good banking, saving, borrowing, paying it back. And I believe that you're creating good habits when you do that. It's very important to do that. Now, we've been asked at times as Americans whether we should put money into a community savings group. And my understanding is it's very risky because many people in developing nations are so accustomed to foreign developing nations, people putting money into their hands or into their system, and the prevailing thought is the Americans don't really need this money back, so I don't need to really pay it back, and there's absolutely no way for it to get paid back or to be assured it's paid back, so frankly I don't do that. Now down the line I may consider following banking procedures, and now with someone has been committed to a community savings group for a couple years, and that the group will vouch for that, and that they will vouch that that's a trusted person, and that person is not starting, because I wouldn't loan money for a startup, no way. I might give a little bit of money to just seed money to help somebody, but not loan, not anything I want to just let it go bye-bye. And then as that person has grown to a point, this could be a purchase of a piece of equipment or a piece of property or something that advances an already existing business. Now I might be interested, and I will be very more interested because when we follow a general banking procedures, if I loan the money, I'm going to have tied up some way to the best of my ability to create a secured loan. That loan is following banking procedures. It's not a statement of integrity of the borrower. It's a statement of following standard banking procedures. So I hope this is helpful. It's a bit of a summary, and I hope you understand there's clearly a difference. Loans are loans. You can borrow it for a lot of things, but if you're not careful, you'll be very disappointed. Maybe somebody didn't loan you the money, or you weren't able to pay the money back. You've got to be willing to risk something in order to get a loan that's more than just a little bit of startup money. You've got to be able to risk another asset beside the equipment or something to convince the lender that you're trustworthy to pay that back. Thanks for being a part of Inspiring Better Business.